Hi, and welcome back to yet another exciting week of the Lazy Money Game. In this week's episode, I will give you an update to my portfolio, since there are some pretty interesting news, which gives me the opportunity to elaborate a bit more about the S&P 500. So let's start with a portfolio update. The first thing we immediately notice is that there was a red circle for this week's episode. If we then go to the portfolio values tab, you can see that the portfolio is down $2,500 compared to last week. At the same time, you can see that the costs have not changed, meaning that I have not done any new investments. If we then continue to my favorites tab, namely the dividends tab, then we can see that May has been a truly exciting month for me, since for the first time ever I am now surpassing the $800 mark in dividends. I mean, this is crazy for me. This is actually enough to cover my rent expenses. So now this really starts to matter. I mean, look at the graph here. Look at how much it has increased. I am truly baffled about this. And if we go to the goals tab, $800 a month, that is actually goal number 47, which I can now cross off my list. Of course, I have to mention the fact that now in June, I would actually expect to receive a little less than what I did in March, since it varies a little whether Nexstar Media Group pays in the beginning of the month or at the complete end of the month. So this month I received the dividends from Nexstar Media Group, meaning that I'm not going to receive them in June. So that's why my number here in May is higher than what I would have initially expected. If we then turn back to the overview arc here and scroll all the way to the top, just to take a closer look at VG, since it has been announced within this week that VG will join the biggest index in the world, namely the S&P 500. And why does this matter? So first of all, if we go to Google, just to show you, in Yahoo Finance, then you can scroll all the way to the bottom here and see that VG will be added into the S&P 500 on June 8th. So why do I care whether or not VG will become part of the S&P 500? Well, if you have listened to some of my previous episodes, you know that I think that passive investing by just buying an index fund is actually a really good idea if you don't have the time, the capabilities, or the resources, or simply just the interest in trying to pick individual stocks. Then buying an index fund would probably be the best investment you can do. Well, if you then for a moment look at economic theory here, you have supply and you have demand. It's not like they are offered more shares of VG just because they are becoming part of the S&P 500. Well, but since they are becoming part of the S&P 500, all of a sudden, all these people who are buying passive index funds will ramp up the demand for these shares. So that would mean that the price of the shares would have to increase, since there simply just is a larger demand. Of course, this doesn't have to happen over the next week or the next month, but over time, this should definitely increase the price, at least according to theory. And that is why I really care about stuff like this. So if we go back to the overview of the portfolio here, then the natural question to ask would of course be, are you then tempted to buy more into VG properties at the current valuation, since you clearly expect that the share price should increase given this higher demand? Well, if I have to remind myself of the words of Buffett and Munger here, saying that they do not try to time the market, they simply buy whenever they see an attractive valuation of a company. But at the other hand, if you listen to all the news that has been out this week, for instance from the CEO of JP Morgan, Jamie Dimon, saying that we should fear a hurricane in the financial markets, and we know that the Federal Reserve have to increase the interest rate in order to try and fight the inflation. And again, from an economic theory perspective, we know if interest rates go up, it acts as a form of gravity towards the stock market, meaning that you are discounting future cash flows harder, meaning that you should pay less for your shares since they do not hold up with the current valuation. Then you can actually argue that perhaps now is not the best time to buy, since you need to find more attractive prices, since the price probably isn't so attractive today. So let me try and explain this through an example. So if we, for instance, look at Disney, if we go to Seeking Alpha here, you can see year to date is down a little more than 30%. Next, you can see that the PE ratio is around 26. So if we expect that the interest rates are supposed to go up, and that seems like a really valid concern, given the expectations from Jerome Powell and the Federal Reserve in order to fight inflation. And one thing you have to take into consideration, if they are pushing the economy into a recession, well, what happens in a recession? Then earnings on companies would have to come down, since that is what have always happened in recessions. So if the earnings go down, that means that the PE ratio must contract. If the PE ratio is contracting, well, then we should actually expect even lower share prices. And to put this in perspective of Buffett and Munger, well, they would say that they're not trying to time the market. They would simply look into the businesses and say, currently, they don't really seem to find a bargain since there is too much uncertainty. They don't think that there is a margin of safety if they are expecting that earnings would be dropping. So if we, instead of looking at Disney, turn into VG, and since VG is a REIT, there is no PE ratio, there's a price to FFO, just think of this as a PE ratio. Well, then, if you previously thought that buying at a price to funds from operation of 18, then given that the circumstances have now changed, namely that you expect interest rates to increase, and at the same time you fear that a recession is coming, and you would expect that the funds from operation would drop, then instead of buying at a price to funds from operation of 18, then perhaps given these changed circumstances, you would say this would only be a bargain if you can get it below, let's say 14, for instance. This is how Buffett and Munger would argue that they are currently not capable of buying any businesses since they couldn't find them at an attractive valuation. Instead of saying that they are trying to figure out what the market is doing, they are doing value investing, trying to discount the cash flows between now and Judgment Day for each individual business that they are trying to invest in. So this is simply the purest form of value investing. So if we then go back to my portfolio and look at VG here, I have now presented counter arguments, namely that the demand should go up, given that they will be part of the S&P 500, but at the same time, there is a real fear that interest rates will go up, and there's a real possibility that the US economy will hit a recession, so we should expect earnings to come down, or in VG's case, funds from operations. So since I'm looking at a scale where I have these arguments on both sides, and I don't really have a clear picture of what weighs the most, well, then I have the privilege of being an investor, and if I don't see a clear picture, then I should simply just be patient and remind myself of Buffett and Munger's words and say, if I can't find anything at an attractive valuation, I should simply pile up my cash until I see such a possibility. So that actually sums it up for yet another exciting week of the Lazy Money Game. So if you have made it all the way to the end, I really hope you have enjoyed the content. If that is the case, then please consider leaving a like. It really helps out the channel a lot. And until I see you next time, bye!